Hi, everybody. This is Joe Gordon. I'm back from a couple weeks off, letting one of the other young bucks do the weekly update. But today's the update for August 18th, 2020, and a lot of things are fluid and changing and going on. So this will be a brief update today. Here's the disclosures. You've seen this slide before. We're not giving investment advice, tax advice, or really any other advice. Just trying to give you good data, updating everything going on in coronavirus bill, plus the markets, plus the Fed, plus politics, geopolitical, etc. So you can follow us on YouTube. You can go on youtube.com and do a search of Gordon Asset Management, and you can see every one of these presentations uploaded to view at your leisure. And also, you can sign up at wealthqb.com. So moving right into the start-off slide on the coronavirus, you can see here cases jumped from 4.7 million last week to 5.242 million, and that's graphed here in purple, trending up. More people are getting tested. There's more cases. There's also hotspots, which is called some state governments to lessen the opening up and do partial shutdowns. Also, you can see that the hospitalizations decrease, which is a good sign, 53,000 to 43,000 week over week, which is good. And then, and that's down here in the blue. And then COVID deaths climbed from 147,000 and change to over 162,000. And that obviously is graphed in orange. And lastly, one of the most important statistics, at least ones from medical doctor clients and also medical doctors speaking on the subject, is that the death rate as a percentage continues to decline. And that you can see that here in the olive green type of shade towards 3%. So that's really the most positive news and the one data point medical experts say you should be tracking. So what's going on internationally? Things continue to rebound and improve a little bit. Developed markets, Europe, Australia, Far East rose 3+% last week, which brings their year-to-date return to only negative 6.47. Also, with the dollar weakening against foreign currencies, especially the euro, it's $1.18 to buy 1 euro. As of yesterday, you'll probably start to see foreign stocks do better, relatively speaking, than they have in the past. 2017 was the last year where there was significant double-digit returns in foreign stocks, and about a third to 40% of that was currency based on the dollar weakening. Emerging market equities rose just under 2%. Year-to-date return just under negative 1.32. Who'd have thought? And then if you look at fixed income, the global aggregate bond index is still up just short of 6% year-to-date. So obviously, in rates falling environment everywhere, you can make money in fixed income. It's not the yield, it's the price appreciation. In the U.S., things look even better, which is kind of scary given the level of unemployment and what's going on. The S&P gained 2.5%, up 4.51% year-to-date. NASDAQ gained just under 3%, is up just under 30% year-to-date. Seems crazy in this environment. And then the leading indicator, normally out of a recession, the Russell 2000, this may be the signaler, climbed up just under 5% last week and is now only down 4.97% year-to-date, which is the green line here trending up. It was down the most at 40%, now just down short of 5%. And then also the Barclays Ag fell a little bit last week, still up just under 7% year-to-date. So people in balanced portfolios, if you've made 7% on your 40% in fixed income, and you made somewhere between 30% or 5% on equities, overall, you're really not having a bad year. Look at sectors by breakdown. We're just going to focus on what's the worst and what's the best. You can see energy still down 35% year-to-date. Natural gas has been spiking, so people that have invested there a little bit are doing well. A lot of the big oil producers have been cutting dividends and CapEx also to save cash, but also financials still down 18% year-to-date. And again, this quarter is July 1 until yesterday. So really we're looking at year-to-date figures, which is through yesterday. So those are the two worst sectors. Those are arguably the best values are. And look at where the money's been made. Technology, 26%, consumer discretionary, 22%, And then related to technology, communication services, just under 10%. Those have been the best sectors. Keeping an eye on utilities, up pretty good this quarter so far, and consumer staples, but also utilities as nearing year to date of only -5, which is good. Real estate also trending in the right direction. Returns and valuations by style. We look at this every week. If you look at year to date, growth up 22%, large cap over large cap value down 10%. So that's just unbelievable. 3 times your money to be in growth, and that's led by the megatechs, which we'll look at in a sec. But the story's the same whether you're investing in mid caps or in small caps. And again, value stocks tend to own a lot more materials and financials and energy. Those have been the worst places to fish. And then obviously on growth, you're mainly technology, biotech, life sciences, communication services, et cetera, been the best. If you look at it historically, since the market peaked in October of 2007, you're up 300% in growth, large growth versus 90% in value. So over 3 times your money there, over 2 times your money in mid caps, and over 2 times your money in small caps. So it doesn't really matter whether you're in small, mid, large. Growth has been the place to be. Since the market depth in March of 2009, when things turned around, you can see large growth has doubled almost large value, and it's not a double, maybe 50% more in mid caps and the same in small caps. So clearly, obviously, we're in a momentum type of rally, a sustainable secular bull market. And obviously, the growth names are where people are putting their money. There's just no doubt about that. So if you look at disparity between cap-weighted and equal-weighted indexes, it just demonstrates how the largest stocks are driving the gains. So the purple is the NASDAQ 100 change year to date, just under 30%. And that's the NASDAQ 100 is the 100 largest stocks in the NASDAQ index by market cap. If you look at the same index but equal weight those names, you can see in orange it's up just under 17%. So clearly an equal weight index gets you good returns, but if you're in market cap, those big megatechs have driven you almost 2 times that of the equal weight index, which is something to take notice of. You can see the S&P percentage change at 4.58 on an equal weighted basis is down 4.5%. And so that's why a lot of folks are saying, well, outside of the megatechs, there's a lot of value in the market across many, many sectors. If you look at the megatechs, and here they are, they're all graphed. You can see year to date in green is Amazon, up 77%, just crazy. They're growing like a weed. And then also you've got in orange Apple, which is going to split at I think August 31st, 4 to 1. Not that that means any more value. It certainly doesn't. You just have 4 times the shares at 1/4 the price. But still, Apple's giving a lofty crown of valuation, and it's up 56% year to date. And then you see the other folks in there. Microsoft up 33%, Facebook up 27%, and then the Alphabet, which is Google, up 14%, more or less. And then the S&P down there at 4.6. And again, of the S&P index, about just under 23% are these 5 names. Again, both share classes of Google and then the other 4 names. So valuation measures, we look at this. So here we are back going into the tech bubble height of 98, 99, 2000. And then we're over here, we're getting close to that all-time high on the Cape-Shiller index and the PE ratio, 22 times. But again, those 5 megatechs are all trading north of 30, 35 Amazon I saw is more like 70 times earnings, which is crazy, but they also are growing top line revenue as well. So that's bringing this number up. The other 495 stocks are still trading at about 16 times earnings, and that's really, again, where the value is. So Federal Reserve balance sheet, why has the market gone up? Clearly, the Fed has been pumping it up. Liquidity, you can see the Fed balance sheet expanding by just short of $3 trillion here. And where we are right now, as everybody knows, is the House wants $3 trillion more. The Senate and the White House, with Steve Mnuchin at Treasury leading the argument, they want $1 trillion more and the House said we'll meet you at $2 trillion or no deal. So there is no deal, and then Trump went to writing executive orders to extend unemployment, I think at 400 a week, not the 600, which is keeping people from wanting to come back to work, and so forth. And there are other things in there on the table, payroll tax deferment, et cetera. So we'll see how it all plans out. It doesn't look like anything's going to happen in that impasse between the two chambers, the House and the Senate. Inflation in gold, and this is an interesting indicator here. Usually gold is a leading indicator of what's going on. It's up just under 29% year to date. A lot of that's because the money supply has expanded so much because of the Fed liquidity, and so now everyone's rotating into gold. The big news over the weekend, published in Barron's, was that in a quarterly filing, Berkshire Hathaway mentioned that they had sold a lot of financials in Q2, and they bought a ton of Barrick gold, which sent that up 10% yesterday. If you just owned exposure in large cap gold miners and silver miners in the ETF GDX, you were up 3 to 4% yesterday. And by the way, most gold miners are up 40% year to date. They're pausing a little bit last week, but we'll see. If there's a deal and we're going to spend another trillion, 2 trillion, 3 trillion, you can bet those are going to continue to rally. That's just the way that it goes. So one key thing here to note is this blue line, and it's the velocity of money. And the key thing about the velocity of money is that even with the Fed throwing so much money at the issue, the velocity of money, the times it turns over in the economy, is still trending way, way down. And it's been that way short term, but in a bigger graph, it's been that way since 2009. So then looking at traditional inflation indicators, some argue, well, they don't reflect the money supply increase in M2 with all this Fed liquidity, but they may not also reflect the velocity of money, also trending way down to offset all that liquidity. So it's kind of like one factor negates the other. But still, you can see here there is no headline inflation at all. If anything, you could argue with the major impact of technology adoption in the stay-at-home economy and the disruption is that costs are going down, and people as people massively adapt to the digital economy. So U.S. unemployment's improving. That's interesting. Continuing claims, 15.49 million versus 17+ million the prior week. Initial claims rose 963,000, down from 1,043,000 the prior week. And the unemployment rate is at 10.2%, down from 14.7%. So all those things are trending. However, there is another wave of layoffs coming. Speaking this morning with one of my colleagues, we were talking that the airlines all got bailout money, and they had to promise they wouldn't furlough any employees until October 1st. And many have pre-announced they're going to do that because guess what? Nobody's flying. And then also you've got, even locally in our backyard, Research Triangle Institute, RTI, announced that they were laying off 1,200 people today. I don't know how soon that's going to happen, but probably over the next 4 to 6 weeks. So there's going to be another wave of layoffs, and there's also a lot of people waiting for additional unemployment benefits, which is, again, the impasse with the House and the Senate. One positive note is housing data is improving. Third straight month in July, housing starts are way up. You can see the graph in March, and then fell off a cliff in May, and now up at one of the highest rates month over month in history. And it's just unbelievable. And some of the issue here is that there's now abundantly shortages in supplies of lumber and other materials needed to build homes. I heard on Fast Money on CNBC yesterday one anecdotal comment made by one of the panelists that if you're not one of the big builders, you're not getting lumber. So I feel sorry for the boutique folks. If you have a boutique building company, you're thinking about building a house or upgrading your house, you're probably going to pay out the wazoo for lumber because it's not being done by Lennar or KB Homes or somebody like that. So we already mentioned this, but the lack of the unemployment benefit deal could hurt spending. This is a comment by Walmart's CFO. Walmart came out with huge numbers today on profits and 200% increase in e-commerce sales. Americans and everywhere in the world, people are massively adopting e-commerce and adapting to the stay-at-home economy. So obviously, if people get more money to stay at home and spend, it's going to continue to help the economy. So here's a little question to close out today. Where does history indicate the S&P might trade 12 months from today? This was in a column this morning I saw from the Daily Reckoning. It's called Rational Exuberance. And so here are your multiple choice questions. Where do you think the S&P might be 12 months from today? Clearly, you got one negative number, almost down 4%. You got a 0, and then you got down almost 12%, and then you got middle of the road up 4.7, up 9.4. So what would be your guess? The answer, 9.4. So on average, the S&P gains 9.4% in the year following a 100-day rally of 22% or more. This 100-day rally is over 50%. Obviously, the 50's coming off a very low base with the shock of a 33% downdraft caused by the massive global shutdowns beginning in mid-March. So what are we watching at the end of all this? We're obviously keeping an eye on COVID, vaccine, second wave of infections. A lot of people think the second wave is really just the first wave deferred, and I would agree with that. Major issues, everyone knows schools, and a lot of folks are upset because they want their kids in schools. A lot of these people that are saying this are two-income families, and they cannot effectively work if they have young children in particular. They have to supervise. Imagine a 7-year-old having to be on a computer from 5.5 hours straight a day doing things when their mind wanders. It's going to be difficult to manage. And then a lot of kids in the stay-at-home don't have the proper equipment. So that's a whole political thing I won't get into, but it is a major issue financially. And to the extent schools are online or this whole thing doesn't work, obviously that's going to have an impact on spending. Now we got the election, as everyone knows, less than 90 days. The Democrats started their virtual national meeting last night. I didn't watch it. I go to bed before those kind of things come on, but I saw a few comments today, which on one hand were comical, on the other they're scary, about the socialist bent going mainstream, as Bernie Sanders said apparently in his speech. And then you got new stimulus efforts, which we just mentioned. Who knows what's going to happen here? It's political. And then inflation versus the money supply expansion, and then the velocity of money falling off a cliff. I don't see inflation being an issue, but you will see gold continue to go up as a function to money supply expansion. So watch what the Fed does liquidity-wise. And then you've got social unrest. We've never seen something like this. It's worse than even in the 60s. I was a youngster then. But the social unrest and the merciless beating of innocent people is just crazy. I've never seen something like this. It looks very third world country-like. It's very scary. And then market breadth with the concentration of so few driving the market up, that's a concern. We've said that many times. And then corporate earnings. A lot of corporate earnings are doing okay, but a lot of them eliminated guidance. So with all that said, kind of an interesting thing we're watching also that's is here at market breadth. One thing, final comment, is that a lot of the NASDAQ stocks had seemed like they were pausing a little bit, and they are trading, many are trading at lofty multiples of sales, not even earnings. And but that seems to have resumed itself this week. They were pausing last week, and instead of the gold miners being up 40% in the last 90 days, they were pausing too. So we'll see what happens, but a lot of people talk about barbelled investments. You have a sleeve of technology, a sleeve of gold miners as a hedge to bad things happening, maybe an allocation to gold, and then you buy the stay-at-home stocks like Walmart and Home Depot. They had record earnings today, and Kroger and Target, and all the companies are going to do extremely well via e-commerce. So with that said, have a happy Tuesday and have a great rest of the week. And it's hard to believe we're almost at the end of August. Thank you.